students, welcome to the online class on marginal costing and absorption costing. I am Dr. Suprava Sahu, faculty member of the PG Department of Commerce, Ravenshaw University. Today we will be discussing about absorption costing and marginal costing, which are covered in Unit 4 for BCOM Honours 4th semester students under the subject Management Accounting. Now my dear students, what do you mean by absorption costing? We have read cost sheet in earlier units. What does cost sheet do? While calculating cost sheet, what we do is that we consider all types of costs, both fixed cost and variable costs. We classify them into direct cost and indirect cost. Indirect costs are classified under overheads and we calculate the total cost. Absorption costing, what it does is that it considers both fixed costs and variable costs while calculating the total cost of a product or service. Absorption costing is also called as fulled costing or total cost technique because it focuses on total cost. Now another concept which we will be covering in today's online class is marginal costing. Now what do we mean by marginal costing? Marginal costing is a technique of costing which only attaches importance to variable costs. It ignores the fixed cost because it does not consider fixed costs as relevant for decision making. Why? The reason being that fixed costs are not controllable costs. They are anyways to be incurred whether we carry on production or we completely stop production. Now my dear students, let me discuss with you certain characteristics or features of absorption costing. One important point regarding absorption costing is that it considers the total cost of a product. Meaning it considers both fixed costs as well as variable costs while decision making. Another distinguishing feature of absorption costing is that here the cost per unit remains the same only till level of production remains the same. If level of production changes, cost per unit also changes. These are two distinguishing features of absorption costing. Now my dear students, we will also discuss certain important features relating to absorption costing. The most biggest advantage of absorption costing is that it is simple to understand and easy to calculate, as all of us are conversant with the total cost technique. It means we do not have to keep fixed asset cost separately, we do not have to keep variable cost separately, we just add up fixed cost and variable cost to compute the total cost, which makes the process of total cost calculation quite simple. Another big advantage of absorption costing is that it helps us in accurate fixation of selling prices. Why? Because both the components of cost, that is fixed costs and variable costs, are considered as a part of the total cost of the product. So what we do? We keep in mind the total cost, we add a certain percentage of profit and we fix the selling price, which helps us in arriving at the correct selling price. Now students, another big advantage of absorption costing is that it attaches equal importance to both fixed cost and variable costs. Unlike marginal costing where fixed costs are completely regarded as irrelevant for decision making purpose, which is actually not correct. Another big advantage of absorption costing, my dear students, is that gross profit and net profit can be calculated separately, which gives us a clear idea about the profitability position in relation to a particular product or in relation to a particular department. Another advantage in relation to absorption costing is that it also helps in disclosing efficient and inefficient utilization of resources which have been allocated to different departments or to different products, because we can come to know about over absorption and under absorption of both fixed overheads and variable overheads. These are certain advantages of absorption costing. Now let me discuss with you certain demerits or disadvantages of absorption costing. One big demerit of absorption costing is that under absorption costing, preparation of flexible budgets may not be that accurate. Now another disadvantage is that comparison of control of costs also becomes difficult under the process of absorption costing. And another big disadvantage in relation to absorption costing is that it is not that helpful to the management in taking important managerial decisions like whether to produce a particular product or component in the factory or to purchase it from the supplier, and whether to, let us say, accept a particular export order or not to accept it, whether to fix the selling price at a certain level so that we attain a given level of profit. These things can be done better in case of marginal costing. These are certain disadvantages of absorption costing. Now, my dear students, we come to another concept, that is marginal cost. Marginal cost is a term which is used in case of marginal costing. Now, marginal cost, what exactly do we mean by marginal cost? Marginal cost refers to the increase or decrease in the total cost of a product by producing additional or fewer units of the product. Let me make it clear with an example. Suppose a firm is currently producing 10,000 units. Let us say the total cost of producing 10,000 units comes to rupees 1 lakh. Suppose the firm tries to increase its production and now produces 10,100 units. And if the total cost of producing 10,100 units, let us say, comes to rupees 1,20,000. So, my dear students, just see here, while producing 10,000 units, the total cost was rupees 1 lakh, but while producing 10,100 units, the total cost increases to rupees 1,20,000. So, what is the difference? What is the increase in the total cost? It is 1,20,000 minus 1 lakh, that is 20,000 rupees. It means that here initially we were producing 10,000 units, total cost was 1 lakh, but for producing 100 units more, we are incurring a total cost of 1,20,000. Now, this 20,000 rupees increase in the total cost, that is called as marginal cost. Now, my dear students, we have come to a detailed discussion about marginal costing. Now, marginal costing is also called as variable costing, because as I have told you earlier, in marginal costing we only regard variable cost as important for decision making. Fixed costs are not considered as relevant for decision making. Let me discuss with you certain assumptions about marginal costing. The biggest assumption of marginal costing is that fixed costs are not regarded as relevant for decision making because they are beyond the control of the management. They are uncontrollable costs. So, we consider only variable costs while taking managerial decisions. Another big advantage of assumption of marginal costing is that the selling price per unit remains constant irrespective of the level of production or sales. Another assumption of marginal costing is that variable cost per unit also remains constant irrespective of how many number of units we produce. Total variable cost will increase when production increases. Total variable cost will decrease when production decreases, but variable cost per unit will remain constant throughout irrespective of the number of units produced. And another major assumption of marginal costing is that the total fixed costs remains the same throughout irrespective of the level of output. So, my dear students, these are certain assumptions relating to marginal costing. Now, let me just briefly discuss with you the distinction between absorption costing and marginal costing. As it must have become obvious to you by now, the biggest distinction between absorption costing and marginal costing is that absorption costing focuses on total cost, that is both fixed cost and variable cost, but marginal costing only focuses on variable cost. That is the biggest distinctive feature between absorption costing and marginal costing. Now, another distinguishing factor between the two methods of costing is that in marginal costing, contribution is regarded as the most relevant point while taking a managerial decision. A product giving more contribution will be given preference in comparison to a product giving lesser contribution. But in case of absorption costing, the important factor is profit. A product yielding higher profit is definitely given preference to a product yielding lower profit. These are basically the two distinguishing features between absorption costing and marginal costing. Now my dear students, let us discuss certain advantages of marginal costing. Now the biggest advantage of marginal costing is that it is a fact that fixed costs are uncontrollable. So why to give importance to fixed cost? So marginal costing does not consider fixed cost as relevant. It considers only variable cost as relevant for decision making, which is quite logical. Another advantage is that marginal costing, like absorption costing also, is a simple and easy technique which can be easily adopted by all business firms. And another advantage is that since fixed costs are totally ignored in case of marginal costing, the problems arising due to under absorption and over absorption of overheads in relation to fixed overheads is not existing in case of marginal costing, which is there in case of absorption costing. While discussing about absorption costing, I have discussed with you that we cannot take important managerial decisions like whether to make or buy a certain component, whether to accept or to reject an offer, and what should be the desired level of sales to achieve a certain level of profit. But in case of marginal costing, we can calculate all these important factors quite easily and with great degree of accuracy. Now students, another important plus point in relation to marginal costing is that it can be used along with budgetary control and standard costing also. So it is complementary to both of them and it can be used along with them to aid in better managerial decision making. So it must have been clear to you that marginal costing definitely has a lot of plus points in comparison to absorption costing. Now my dear students, let me highlight some demerits of marginal costing. One demerit is that in marginal costing we are assuming a lot of things. We are assuming selling price per unit remains constant throughout. We are assuming that variable cost per unit remains the same throughout, which might not always be true. So what happens is that marginal costing is based on a number of assumptions which might not always be true in all cases, in all circumstances. Another demerit, big demerit of marginal costing is that it completely ignores fixed cost. Fixed cost cannot be completely ignored, but this concept does that, which again is a negative point. Now my dear students, another disadvantage in relation to marginal costing is that sometimes it doesn't become possible to segregate all costs into fixed and variable components. So that also creates difficulty in marginal costing. Now another disadvantage of marginal costing is that it completely ignores the time factor. Let us say there are two products, product A and product B, giving the same amount of contribution. But let us say product A is giving the same amount of contribution within a lesser time period. So that should be given preference in comparison to product B, which is yielding the same amount of contribution but within a longer time period. But that time factor is completely ignored in case of marginal costing, which again is not a positive point in favor of marginal costing. Now students, another very important and critical point is that variable cost per unit does not always remain constant because of the law of diminishing and increasing returns. But in marginal costing we assume that variable cost per unit always remains the same. So that is also another disadvantage of marginal costing. Another disadvantage of marginal costing is that total fixed cost does not remain the same throughout. It might change beyond a certain level of output. So students, we have discussed till now absorption costing, the distinguishing features, merits, demerits. We have also discussed about marginal costing, various assumptions of marginal costing, various merits of marginal costing as well as demerits of marginal costing. We have also touched upon the concept of marginal cost and what it exactly means. Now students, we will be discussing certain important concepts which are covered under marginal costing. We will discussing them in detail. Important concepts which are covered in marginal costing. Now, the most important concept which is covered in marginal costing is contribution. Now, what do you mean by contribution? Contribution is the excess of sales over variable cost. It is denoted like this: C equals to S minus V, where C means contribution, S means total sales and V means variable cost. Contribution can also be calculated per unit. We denote it like this: CPU, meaning contribution per unit, equals to selling price per unit minus variable cost per unit. So, remember my dear students, contribution is the most important factor in marginal costing. It is the key element which guides us in managerial decision making. A product yielding a higher contribution is always given preference in comparison to a product yielding a lower contribution. Now, this is the formula for calculating contribution, S minus V. It can also be calculated like this: C equals to F plus P. F means total fixed cost and P meaning total profit, or it can also be calculated like this: F minus L, means total fixed cost minus total loss. In case of loss, we use this formula. In case of profit, we use this formula, and in case we have got data about total sales and total variable cost, we will use this formula, S minus V. Now, contribution, as I told you, it is also quite helpful to the management because contribution helps the management in fixation of the break-even point. Break-even point we will be discussing little bit later on. It helps the management in fixation of the break-even point, which is denoted like this: BEP. You can note it is called as break-even point. And another advantage of contribution is that it enables the management in fixation of accurate selling price. These are two major merits of contribution. Another big advantage in favor of contribution is that it also helps the management to decide about the most profitable product mix. Which mix of various products will yield the highest profits. And contribution also helps the management in deciding about whether to continue with a particular product or to discontinue it in case the product is incurring losses. These are certain merits of contribution. So, this was one concept which we discussed in relation to marginal costing, most important concept, that is contribution. Now, students, we come to another concept which is called as marginal cost equation. Marginal cost equation. Now, students, marginal cost equation denotes like this: S minus V equals to F plus P, or F minus L. So, S minus V means total sales minus total variable cost equals to total fixed cost plus total profit, or total fixed cost minus total loss. In case there is loss, in case there is profit, we will use the former formula. In case there is loss, we will use this formula. This is called as the marginal cost equation. Now, students, another concept which is covered in marginal costing, very important concept, that is your PV ratio. PV ratio. P denotes profit and it basically expresses the relationship between the amount of profit and the volume of sales. Higher the PV ratio, the more profitable a particular product or a particular department is. PV ratio is calculated like this: PV ratio equals to C by S into 100. C means contribution, S means total sales into 100, or instead of C also you can use or F plus P or F minus L by S into 100. So, PV ratio is an indicator of efficiency of a business. The higher the PV ratio, the better a business is doing in terms of profitability. Now, another important concept in marginal costing is break even point. break even point. As the name suggests, break even point. It means the point at which we are breaking even. It means the business is neither earning profits nor it is incurring losses. So break even point, you can tell it as a point of no profit, no loss. We are breaking even. We are at least recovering the costs. That is called as break even point. Point of, you can say, no profit, no loss. Now break even point, we can calculate it in terms of units. In terms of units we can calculate it. In terms of units, break even point will be stated like this: total fixed cost divided by contribution per unit. In terms of units, break even point equals to total fixed cost divided by contribution per unit. Break even point can also be calculated in terms of monetary value. In terms of monetary value also we can calculate break even point. We denote it like this: break even point in terms of rupees. It is equal to F into S by S minus V. Total fixed cost into total sales divided by total sales minus total variable cost. Or we can use another formula also: total fixed cost divided by PV ratio. Total fixed cost divided by PV ratio. Suppose the total fixed cost is rupees, let us say 50,000, and the PV ratio is, let us say, 50%. So 50,000 by 50%. So the break even point in terms of rupees will be rupees 1 lakh. And if we want to calculate the break even point in terms of rupee, we can either use this formula or this formula, looking at whatever information is given in the question. Break even point is a very critical component of marginal costing. Now students, another important concept which is covered in marginal costing is margin of safety. Margin of safety. Now what do we mean by margin of safety? Margin of safety means the excess of actual sales over the sales at break even point. So margin of safety actually means total sales minus sales at break even point. So suppose the total sales comes to rupees 50 lakhs and the sales at break even point comes to 40 lakhs. So 50 lakhs minus 40 lakhs, that is 10 lakh rupees will be the margin of safety. Margin of safety is an indicator of the efficiency of a business. The higher the margin of safety, the better it is for the business. A margin of safety can also be calculated in terms of another formula: MOS equals to P divided by PV ratio. P means total profit divided by PV ratio. Suppose total profit comes to rupees 1 lakh and PV ratio comes to, let us say, 50%. So margin of safety will be rupees 1 lakh divided by 50%, that comes to rupees 2 lakhs. Margin of safety will be rupees 2 lakhs. So these are certain important concepts which we are discussing in relation to marginal costing. Now students, we will cover another important concept relating to marginal costing, that is angle of incidence. Angle of incidence. It refers to the angle between the total sales line and the total cost line. Angle, it refers to the angle between the total sales line and total cost line. So it is formed at the break even point when the total sales line and the total cost line intersect each other. Angle of incidence is formed at the break even point. Angle of incidence indicates the profit earning capacity of a business. Higher the angle of incidence, the better is the profitability position of a business enterprise. So, we have covered angle of incidence. Now, another important part related to marginal costing is problem of key factor or limiting factor. Problem of key factor or limiting factor. Now students, all of you must be aware of the various factors of production like availability of raw materials, availability of laborers, manpower, labor hours, then availability of capital and maximum capacity at which a plant can operate. These are all our factors of production. So factors of production basically refers to those resources which are available in limited quantity, and factors of production put a limit on the maximum amount of profit which a firm can earn. So when it comes to key factor or limiting factor, what a business house has to do, it has to see which product is giving the highest contribution per unit of limiting factor, and that product will be given preference in comparison to other products. I'll just make it clear with an example. Suppose a company is producing 3 products, product A, product B, product C. Let us say here the key factor or the limiting factor or the factor which is available in scarce supply is the labor hours, manpower. So what we do is that we calculate contribution for all the 3 products A, B and C. We see which product A or B or C is giving the highest contribution per labor hour, and we select that product in comparison to the other products. So this is the problem of key factor or limiting factor. We give maximum importance to whichever product is giving the highest contribution per unit of limiting factor. Now students, it must have been clear to you that as comparison between marginal costing and absorption costing, each technique of costing has got its own merits and own demerits. But in managerial decision making purpose, marginal costing definitely is the superior technique. Now one more portion which is there in a unit 4, which I will be discussing with you now, that is called as cost indifference point. Cost indifference point. Now cost indifference point is that level of volume of sales where the total cost and profits are the same, irrespective of whatever alternative or production we use. So this cost indifference point, we should not get confused and think that it is the same as break even point. Cost indifference point basically means that point at which the total cost lines of 2 alternative methods of production intersect. But break even point means the point at which the total cost line and the total revenue line or the total sales line intersect each other. And cost indifference point can be calculated like this. Cost indifference point equals to difference in total fixed cost, difference in total fixed cost divided by difference in variable cost per unit. The formula to calculate cost indifference point is difference in total fixed cost divided by difference in variable cost per unit. Now students, remember and keep it in mind that cost indifference point is very helpful in taking various decisions like which should be the marketing plan which a company should adopt and which method of production a company should choose from various possible alternatives. And It is a very important point to be kept in mind while taking strategic managerial decisions. Now students, if you come to absorption costing and marginal costing, basically in later classes we will be discussing about various decision making techniques also. One important factor which is covered, one important concept in marginal costing is desired sales. Another more important factor, desired sales. Now students, desired sales means the level of sales which a company has to achieve in order to achieve a certain given level of profit. Suppose a company wants to earn rupees 20,000 profit, and how much sales it has to achieve in order to earn 20,000 profit. The formula to calculate desired sales is desired sales equals to F plus P by PV ratio. F plus P by PV ratio. Now suppose students, the total fixed cost is rupees 5 lakh. And as I have told you here, the company wants to earn rupees, so total fixed cost is rupees 5 lakh and the company wants to earn rupees 20,000 profit. So P equals to 20,000. PV ratio, let us say it is given in the question. It comes to, let us say, 50%. So what will be your desired sales? F plus P by PV ratio. So desired sales equals to rupees 5 lakh plus 20,000 divided by 50%. So it comes to 5 lakh 20,000 divided by 50%. It comes to 10 lakh 40,000 rupees. So desired sales means the level of sales which a company has to achieve in order to attain a certain level of profit. In our example, we have taken this, fixed cost is 5 lakh, desired profit is 20,000, PV ratio is given in the question 50%. So desired sales will be F plus P by PV ratio, which comes to 5 lakh rupees plus 20,000 rupees divided by PV ratio of 50%. So that comes to 10 lakh 40,000. So with this much fixed cost, this much amount of profit, this PV ratio, the sales should be 10 lakh 40,000. Discuss about some problems relating to marginal costing. First of all, I will discuss about cost indifference point. As I have discussed with you earlier, the formula relating to cost indifference point equals to difference in total fixed cost divided by difference in variable cost per unit. Now let us assume the difference in total fixed cost between two alternative methods of production comes to rupees 2 lakhs. And suppose the difference in the variable cost per unit between two alternative methods of production comes to rupees 5. So cost indifference point will be rupees 2 lakh difference in total fixed cost between two alternative methods of production divided by difference in variable cost per unit, that is rupees 5, which comes to 40,000 units. Now as I have told you earlier in the class, cost indifference point is very important for taking various managerial decisions, like which marketing plan to use, which method of production to use, and the like. Students, I have discussed with you about PV ratio. So PV ratio I have told you earlier equals to total contribution by total sales into 100%. It is expressed as a percentage, but sometimes what happens? We are given the figures of profits and sales for 2 years. So, we have to make a comparison. So, in that case, whenever profits and sales of 2 years are given, the formula for calculating PV ratio will be PV ratio equals to change in profits divided by change in sales into 100%. Suppose we are given the data for 2 years, 2018 and 2019. These are the year column. And the figures of sales is given to us, rupees, and the figures of profit is given to us in rupees. Suppose in 2018 the sales was 20 lakhs and in 2019 the sales has increased by 5 lakhs, it has become 25 lakhs. Let us assume that the profit in the year 2018 was rupees 5 lakhs and in the year 2019 it has increased to 7 lakh 50,000. So, how will we calculate PV ratio? It will be change in profits divided by change in sales into 100%. So, we take the profit of the later year. What was the profit in 2018? 20 lakh and in 2019 it was 25 lakh. So, change in profits will be rupees 25 lakhs minus rupees 20 lakhs divided by change in sales. Sorry, this is the change in profits. So, it will be 5 lakh minus, it will be 5 lakhs minus 7.5 lakhs. Change in profits divided by change in sales. Just correct it again. It will be change in profits divided by change in sales. So, it will be rupees 7 lakh 50,000 minus rupees 5 lakh divided by change in sales. Sales in 2019 was rupees 25 lakhs. So, 25 lakhs minus rupees 20 lakhs into 100%. So, it comes to 2,50,000 divided by 5 lakh into 100%, which comes to 50%. So, this is another method to calculate the PV ratio. Whenever the profits of 2 years are given and the sales of 2 years are also given, change in profits divided by change in sales into 100%. My dear students, we have also calculated break-even point both in terms of units as well as in terms of monetary value. Now, break-even point can also be calculated as a percentage of capacity. So, break-even point, whenever we calculate it as a percentage of capacity, break-even point equals to fixed cost divided by total contribution. Whatever fixed cost is given in the question, whatever contribution is given in the question, we apply it in the formula to get the break-even point. So, these are certain basic concepts which we have discussed in today's class relating to absorption costing and marginal costing. So, in this particular concept, what has happened is that we have seen that marginal costing is definitely more suited for managerial decision making more, because it focuses on those costs which are controllable, that is variable cost. Why marginal costing does not consider fixed cost as relevant for decision making? Let me just explain to you by a very simple example. Let us take a classic example of fixed cost, that is rent. Suppose a businessman, a producer of goods or manufacturer of goods has taken a building on rent to use for the purpose of his factory, and let us say he is paying a rent of rupees 1 lakh per month. Suppose in the month of January 2020, he has produced, let us say, 20,000 units. How much amount of rent he will have to pay? The same amount of rent, whatever is fixed with the landlord. Let us say in the month of March, due to COVID-19 and all the repercussions arising out of that, he is unable to produce to his capacity. He is able to produce up to only 20% of his capacity. That is, he is producing very less as compared to the month of January 2020. Will the landlord waive a certain percentage of rent? No. Why? Because rent is a fixed expense. The landlord is not responsible why he is producing 0 units or why he is producing 10,000 units. That is why rent is a fixed expense. It's an example of a fixed expense. The purpose of giving you this example is that fixed costs are not controllable. They are not controllable. That is why they are called as period costs. Variable costs are controllable. That is why they are called as product cost. They are chargeable to the product. Now students, we have also discussed many concepts relating to marginal costing like contribution margin, which is regarded as the most important element in marginal costing for decision making. We have also discussed how in case of limiting factor or key factor, we consider contribution per unit of limiting factor as the criterion for choosing a decision. Let me just explain to you a very simple example. Suppose there is a factory which is manufacturing 2 products, product A, product B. Suppose we calculate the contribution and the limiting factor here is number of labor hours available. Suppose, just to imagine, the contribution per hour of product A comes to rupees 25. Suppose the contribution per hour of product B comes to rupees 45. So definitely we should select the product B because contribution per limiting factor, here the limiting factor is labor hours, is higher in case of product B. That is the criterion for selection of products in case of whenever contribution is being used. So basically this was an online lecture on absorption costing and marginal costing, which is coming under unit 4 of management accounting paper for BCOM 4th semester honors students of commerce. And my dear students, I, Dr. Suprava Sahu, faculty member of the PG Department of Commerce, Ravenshaw University, at the end of this online class would like to share with you some points. First of all, we are going through a very difficult situation because of this global pandemic, that is COVID-19. All of us are in some sort of stress, and I as a faculty can definitely understand you students must be going through various issues right now. The most common thing in your mind must be how will the course be completed, whether you will have sufficient access to online materials or not. We are regularly uploading our audio lectures, video lectures on the website in the department groups. We are also sending you regular study materials, and in case of any difficulties, any queries, any doubts, you are always free to contact us in WhatsApp group or on mobile. We are always there to help you. Another very important thing which I would like to share with all of you is that please stay at home, follow the lockdown, follow all the instructions of the government regarding COVID-19, stay home, stay safe, and please download the Arogya Setu app. Thank you so much.